Thank you for joining me. My name is Stephen Choi, and welcome to this is Trading with Livevol. And basically, this is where I use my real Reg T account, and then I use LVX to kind of put on real trades, and then you guys can see how I use the product. I just got on, but I was a little distracted because I was doing this spread right here. As you can see, it's the IWM, the 12-10 put spread 1/2. And the reason I got notified of that is I was actually looking at this watch list trades where I basically track all trades that are 1,000 contracts or more, and I saw this thing come up, right, where basically I'm going to actually go down a little. Well, basically this person bought 4,000 of the April 1/10 puts and sold sold 2,000 of the April 12 puts, right? So he did a 1/2, and basically what he is saying, he collected 40 cents doing this. So basically what he's saying that IWM is either going to go above 12 by tomorrow pretty much, or it's going to go down so much that actually you will be able to make money because it'll go below 110, right? So I was kind of looking at this, and I liked it. I like this 1/2, a one-day straddle. If you can almost say, let me actually go to the risk chart. So let me actually make this 10-day. Right, so let me get rid of all this stuff, so it doesn't matter. So this is what I'm putting on. Basically, I have my dead spot right here, right at 1010 at expiration. And then before that, if it goes above 110, I make money. Or in this instance, if it goes, since it's 40 cents, 1160, right? And then I start making money if it falls below probably like 109 or something. So this is a one-day spread straddle. I like that because you're collecting. So I am collecting, you know, so let me actually show you the trades I did just before I got on. So I just did this trade, like literally like this one, like basically a minute before I got on, and I did it for 42 cents, right? So if I punch it up now, they're actually better, like 48 cents and 47 cents, right? So let me actually close this real quick. So basically what I'm saying is that it's going to be higher than this by tomorrow's expiration day. So this week, because of the Good Friday, it's going to expire on Thursday instead of Friday. And this is what I'm basically, what this guy's betting on that I like. So I did a 1/2. Let's see. I'm actually going to try to do another one at 50 cents. Right, so I'm basically, because I liked it for 40 cents, obviously I'm going to like it more if it goes down. So I'm actually doing, I'm going to do more. Basically, my risk is that it goes right to 12. So I'll lose like $1.40 per contract. So that's if I do it 2 by 4, that's $280 that I'm putting at risk. But if IWM really moves, which it has a tendency of doing in the past, we're really going down hard, then I should do okay. And if it rebounds, then I should do okay as well, right? So if you look at it, it's up 0.45%. Let's see what the general market is up. Yeah, SPX is up 0.5%. So it's kind of underperforming. So we'll see what happens. Let's see what it is right now. Right, so I put in for 50 cents, but for some reason I'm not getting filled. So I'm actually gonna cancel, and I'm gonna put it in again for 53 cents. So I'll be selling one at like 90 and buying two for 19 or something. 92, right? So 90. Right, so I'm gonna put it for 50. Oh, all right. I'm gonna put it for 50 again. See if I get filled while I'm doing this video blog. But anyway, that's one. Let me just go to my account real quick. So I'm up a little bit today. Let me actually go through a lot of the stocks I have. So yesterday, I was talking to you guys about the volatility in YHOO, how it was pretty high. And let me actually go to historical trade. So yesterday I did some YHOO. So you can see I sold 5 of these for 61 cents, the May 30 puts in YHOO, because the reason I did that was because I thought that most of the volatility was because people are betting on the upside, and because there is a relationship of pricing between calls and puts. It's called put-call parity. The put price also goes up as the call price goes up. So in my opinion, most of the action was happening because people were buying calls, right? But the puts were being elevated, so the volatility went basically, to the 100th percentile right here, which we notified. So now it's back down to 50th percentile, but yesterday it was at like 97 percentile. I thought it was pretty much way too high for YHOO, especially what I liked was the fact that it was down in this area, right? So if it was like in the 35 area or 37 area and it was 100 vol, I wouldn't have been as comfortable selling the puts, but because it was already down in the 33, 34 area, I felt like the downside from there was far less. So I sold these for 61 cents. It was a one-day trade. And basically today I was thinking of buying these back, but instead I bought these back for 12 cents, I think. Right, so I bought the 5. So basically what I did was I sold it for 61. I bought this back for 12 cents, right? So what did I make? Like 39 cents on this trade. $40 roughly 5 times. So I made 200 bucks, and now I have this free call spread as well on top of it, the 31.30. I'm not really expecting it to collect on it, but I just put it on because maybe I can sell this for higher than 6 cents, the spread, if YHOO has a little downturn or the whole market has a downturn, right? So that's what I was thinking. I also sold some Bank of America puts because I thought they were going to have good earnings, right? So if you look at it here, the May 15.5 puts, right? So if you look at it, I'm gonna go like this. So you see this May 15.5 put, I sold 5 for 26 cents. I sold 5 for 26 cents, and today I had to buy them back for 23 cents. So even with that, I made 15 cents, even though basically B of A is down 2.5%. So B of A is down 2.5%, and I still made some money on this trade, and I'm pretty happy about it. So it was, you know, all these things are one-day trades. So as I see earnings pass by and I see some opportunity, I think I'm gonna play them, but not have like an extended time period of where I just keep them, but I just make an earnings play, and then afterwards, whatever happens, I just close, right? So B of A, I made 3 cents per contract, and on YHOO, I made 39 cents, but I could have probably made more like 53 cents if I just bought the same puts back. So I think overall, it's kind of it was pretty good, and I think it's something that I'm considering doing more frequently, just because my with the Reg T account, I just don't have that much margin to put on these positions and keep them. So, you know, maybe I can do something where I do make a little longer term investment or trades, but then I also try to do like some daily trades, trying to make some income that way. So I did B of A and YHOO, just because it was two that kind of, you know, kind of spoke to me. I also talked about Intel, maybe selling some calls in Intel. I didn't do that, even though I think it would have worked out pretty well, just because I wasn't as comfortable. So if you listen to yesterday's tapes, basically I was thinking of selling calls or call spread in Intel and basically selling puts in B of A and YHOO, and I think all three of them would have worked out pretty well. So, you know, in the end, like, there were a bunch of earnings, but I picked the ones that I recognized. And for most of the guys, you guys who trade, that's kind of how you should do it. So these information is not the end of your trading decision, but it's the beginning, right? So it kind of alerts you on a stock that you're trading, and it lets you actually pick and choose which one to do. Let me actually run through. So basically, my new strategy, or it has been a strategy, but I think I'm going to try to focus more on it, since I haven't been doing too well picking my own strategies. If you guys follow my account, it's pretty much down because I have these two strategies that I followed by myself in Apple and Zynga, and they didn't really turn out too well. So I was kind of thinking like, hey, I'll just piggyback other people's strategies that I like. So out of all these like tons of block trades that are happening, let me actually show you here. I'll just piggyback the ones that I like the best, right? So that was kind of the premise of my thinking, was that I was gonna let these trades generate the ideas for me. So let me actually go through EXC. So basically, somebody bought this put spread, the May-July 34 put spread. It's been kind of on a tear, but this person basically did this put spread, and then so I bought this put spread as well for a little bit better, for 44 cents. I'm not sure what price he did it for, but and I can look it up. But basically, I try to do the same thing, but for a better price. So I have this on for 44 cents, and right now it looks like it's worth like 35 cents, right? I also piggyback IWC. So this IWC is the iShares Russell Microcap Index. Some person basically, he made money on his original trade in April, and then he rolled down into these. So my thinking was I was going to do the same, but he paid 170 or something for these. And what I decided to do was sell the April, the one that expire in tomorrow. I decided to sell this to lower this cost down. So basically, I bought the spread for 130, and then I'll see what happens. So right now the spread is worth about 132, so it's pretty much a push. In Hertz Global, basically, same thing. This person did this roll where they bought the earnings month. So you see like June 27th and sold the April 27th. So I also did that for about 112. And right now it looks like it's worth about 132. So it's actually working out pretty well. Let's go to SPLK. This was one of my favorites, but unfortunately I only did it one time. So basically this person sold the April 65 and bought the May 65 and paid 190. And so I piggybacked that for one nickel better, so I paid 185. And if you can see right now, the spread's worth about maybe 340. So you know, this is like right now it's pretty much at the, it's like at the sweet spot, right? So it's going right to April 65. These are going to pretty much go out worthless, and these have been increasing the whole time that's happening. So after tomorrow or at tomorrow, I can buy these back for like a nickel just before the close and sell this out. And then if I sell it out for more than 185, it's a good trade for me. Coca-Cola. So basically, I saw a huge volume where people are buying this July 39 calls before earnings. I liked it, but I didn't want to pay. You know, I didn't want to pay like $1 or something. But so basically, what I did was I sold the May 40s, and so I did the spread for 50 cents. And right now it looks like they're worth about 90. So you know, I made about 80%, and I'm actually thinking of maybe getting out, but I'm not really sure exactly what to do. So, you know, in the end, like I made money. The spread, the spread theoretically could be worth a ton, but it would only happen if, let's say, I don't touch it. Coca-Cola will have to trade below 40 at May expiration, and then they'll have to rip up to, you know, whatever price afterwards. So we'll see how that works out, but that's my Coca-Cola position. My Micron position that I piggybacked was this May 20 calls, right? So they were paying 287. I liked it because I thought, you know, the 20 level was a kind of a good line in terms of technical support for Micron. So $20 right here. Let me actually go to a 2-year chart. So it's right around here. So it's been hanging there since you know, like December. So for about 4 or 5 months, once it reached it, it kind of has been there for a while. So maybe it's consolidating. $20 seems pretty good. I was kind of generally bullish on the chip sector anyway. So it kind of made it easy for me to piggyback this guy's bet. And I liked it because, you know, you risk $287 or $2.87, but if Micron goes to like 26 or something, you know, it could be worth $6. So I did this because I wanted unlimited upside, and I wanted to cap the downside in Micron. Okay, ACI. So Arch Coal, I saw this person do this spread, the October 6-8. This is a long-term spread, and basically I bought this for 32 cents, and max it could be worth is $2. So you know, if it comes to the point where Arch Coal trades above 8 at October expiration, you know, I'll make 5 times my money. But the chances of it actually going there obviously is not that great. But you know, what am I risking? I'm risking 30 cents, and it's already gone up to 537 just a week ago. So basically, if it keeps going up the way it has been, so see how it's consolidating, but like beginning of like middle of January, end of January, basically it started going up. So if this trend continues, I should do okay in it. And did I talk about Hertz? think I did. Yeah, so I talked about Hertz. IWC. Oh, okay. And then this stock, DLLR, basically I bought this May 10, July 10 call spread for a dime, and then I bought the October 10 call spread for 15 cents. And you guys kind of have heard me talk about this before, but basically I'm just taking a shot that something happens in this stock, and I'm paying very little to take that shot. So as you can see in B of A, you see this trade, and basically I did this trade because of this risk reversal went up. So some huge amount went up again. Well, anyway, basically I did this trade because this 22,000 lot went up, right? So you see how they were buying the puts and selling the calls? Well, they were doing it with stock, right? So in Philex, it was a buy right, but well, what was a stock price and what was when did it go up? So you see how it went 1052, and this is something that's awesome about the software, right? And let me I queued it up. So basically, this Livevol Pro is the same as Livevol X that I'm using, but basically you don't get to execute off of it. But I did it, so I set it up so I didn't have to actually look for it, right? So basically, you go to the underlying trades, and I say, give me all trade sizes above 50,000, and you see this at 1054, 170, 1.7, whoops. Okay, yeah, yeah, I should go back to trades only. 1.755 million shares printed at 1592. It was done in Chicago, and it was a derivative, right? So most likely this was the trade, and this makes sense because this is about the right delta against these options right here, right? So basically what this guy did was he bought this Jan 1515 puts for 101. Then he bought this stock for 1592. So basically 1592, and follow me here and try to stay with me. And if you don't understand it fully, basically I think at the end you just understand the gist of it, and that's the most important. But you see how this guy bought stock for 1592? If you buy stock and buy put, it's exactly the same as buying a call, right? If you buy the stock and buy the put, it's exactly the same as buying the call, synthetically, right? You're synthetically buying the call. So if you paid 1592 for these, right, and then you paid 101 for these, then you basically paid 1693. So 101 plus 1592 is 1693. So 1693, and if you look at these 15 calls, basically you paid, if you subtract the strike price, you paid 193 for these calls, and you sold the 17 calls for 94 cents, right? So you add the 1592 plus 1.01, which you get 1693, right? But you subtract the strike price, so it's actually 193. So he paid 193, or this person paid 193 for these calls synthetically, and sold the 17 calls, the real 17 calls, for 19 cents, right? So overall, he did this trade for 99 cents. Now, many of you guys might want to ask, well, if he wanted to do the call spread, why didn't he just do it? Well, there's a couple of factors. Basically, if you just do the call spread, you're pretty much married to that call spread, right? If you do it with stock, and I've done this many times, is if you buy puts, buy stock, and sell call, you can actually adjust the delta as it goes up and down. So if you look at the time and sales, you see how he actually only did 1.755 million. He actually, if he wanted to do it like a pure play, he would have needed to have bought 2.25 million shares to actually do a call spread exactly, but he didn't do that. And the reason you don't do that is this gives you the opportunity to basically scalp stock the whole year, and then knowing the fact that you have the puts and the calls to kind of offset it, right? So you have the stock, because you have the put, even if it goes down, you're only going to take, once it goes below 15, your puts are going to actually go into in the money, so it'll actually protect you. And if it goes up, well, basically you just have like a buy right situation, right? So this is actually a really good trade because, in my mind, of course, so I looked at that trade, I'm like, man, I love that trade, right? I love that trade. Why do I like the trade? Well, I'm kind of bullish in the banking sector anyway, right? And what is happening is, and let me actually go to monthly. What this is saying is, like, you see how this is April? So basically, like, imagine this amount stretched out this way, right? Basically, you're betting between 16 and 17 range, and you're saying Bank of America is going to be above 17 when it comes to end of this year. And what are you risking? Well, basically, what you're risking is a dollar, right? So if you bought the 17 call spread for $1, basically you're risking $1 to make a max of $1. So you can get 100% return on that trade. So what I did was, since I couldn't do exactly what he did, I did this for 97 cents, right? So you see how I bought this for 193 and sold this for 96. I have a very similar position as this person who put this huge trade on, but I'm actually doing it for 97 cents. If I'm correct and I make $1.03, I'm basically making over 100% return on my money, on my investment. And I think I like this thing because if it goes down, my risk is only that $1, right? So if Bank of America falls off the cliff because the whole market basically crashes, like a lot of the bears are predicting, well, you're only going to lose $1. And to me, the financials, I think B of A, like most banks, in my opinion, have a lot of upside, just because as the curvature gets steeper, these guys have the ability to make money, and they're one of the few sectors that haven't really recovered. And what do I mean by that? I mean, like if you look at XLF monthly, see how high it was before the crash, right? So it was like in the 32 range. It only got back to the 21 range. So I think they have more upside, even though they've come back a lot. And also, if you look at fundamentally, like the price-to-book ratio and things like that, they're extremely undervalued. And it's not that I'm such a huge financial analysis, but just from like a fundamental standpoint, out of all the stocks, they seem to be pretty good. Bank of America, Citigroup, all those general banks. So that belief plus this order flow is making me do this trade, right? So what's important for people to understand is I'm not doing this trade because this order flow only, right? So this order flow is actually reinforcing my belief. So let's say I go, oh, hey, look, I like this trade a lot. I'm going to do it more for 97 cents, right? So let's say I want to do it 4 times, right? So I put it in there, And then if I get filled, basically that's my risk, right? So I'm gonna put like $500 at risk to make $500 maximum if B of A goes up. If B of A goes up before then, well, then I can just roll out and roll into a higher strike, right? So that's one. I also saw this JetBlue block trade that was kind of interesting. Basically, they did this spread right here, JetBlue, right? So I can do the same thing. You see how it wasn't. So let's say I go to JetBlue. So I'm actually gonna, I'm actually gonna try to do this. So I go to time and sales, right? I type in JetBlue, underlying trades. Let's actually do 20,000. All right, so when did that trade happen? 11:39. Yeah, so I don't see anything here that says stock. So basically, this was done naked, as far as I know. So they're selling the May 8 put and buying the May 9 calls, right? And this is before the earnings coming up. So that's a pretty big bet. So he's saying that it's going to be within this 8-9 range, and basically, you see how it's been on this range for a while, and his bet is that it's going to break to the upside and not to the downside, right? And he's willing to pay a dime to put on this trade. Now, normally, I'm not, on this one, I'm not as sure, right? So I would have to sell this and buy this. So let me actually pull that up. So I sell this and buy this, and he paid a dime, right? So let's say I'm okay, willing to do that, but I kind of am bullish on the airlines. I talked about this before. So let's say I believe this guy, and I'm gonna piggyback his trade. But I'm gonna do it only for nickel bits. I don't really know if you bought stock, right? So I'm gonna do it for a nickel. I'm gonna do it twice. And this is a thing that kind of sucks, because if I do this, then basically it eats up my margin. So you know what? Maybe I won't do it right now. I have to think about it. Just because now I'm just shorting it. It's only $8, so it probably won't make that much of a difference. You know what? I'll do a one lot at least. That way I won't forget. All right. So one lot has been sent in JetBlue. So B of A. I also did this IWM trade just before, and I talked to you guys about it. And so we'll see what happens. It's trading 1172. Generally, I like this 1x2 bet. It's almost the thing is, this is self-hedging. So as it goes down, these deltas would increase. These will be maxed out, so they'll increase at a faster rate than the one I'm short. So it'll actually become delta neutral. And then if IWM goes beyond 12 and trades higher than 112, basically the deltas would adjust and they both will shrink to 0. So a lot of these like ratio spread, what's good about them is you don't have to touch them. They actually hedge by themselves, right? So it's one of the things why if you can identify a good one, you can do it. Let me actually see if I ever got filled. So I have 50 cents, but for some reason I'm not getting filled, right? So that's 84 and 17. Yeah, so we'll see. Right now it does not look like I'm getting filled, even though the midpoint is higher, right? But if I sold this for 85 and paid 18, that's 36. Yeah, that's still 49 cents. So yeah, I'm gonna keep this up, see what happens, and hopefully by tomorrow's expiration, IWM trades 112 or higher, or trades way below 110. But either way, I kind of just like this bet, so I put it on. because it's a 1 day. And as you can see, if IWM, the reason I like this, just so you guys know, is if IWM doesn't move from right here. So let's say this is, oh, wait a minute. Okay, so it's weird, but it looks like I got filled on both B of A and IWM at the same time. So maybe the market took a little dive or something. Right. So anyway, so basically I got filled on both, right? So I bought the spread in B of A, 97 cents, 4 more times. So basically my risk is $500, and then I did this spread for 51 cents. So we'll see. So this is pretty much probably the max I'll put on for now, and we'll see what happens. So that's about it. I kind of ran through a lot of stuff for you guys today, and did a lot of. So yeah, you know, I basically my conclusion is I'm gonna lay off trying to bet too much on what I'm thinking, but I'll selectively pick trades that are going up, and I'm going to piggyback them for a better price, right? So that's what I'm doing. So you see how these block trades are going through? Yeah, well, some stocks might actually talk to you guys, but it might not talk to me, and vice versa, right? So maybe somebody's really heavily into Ford, and they can actually, this kind of options order flow is actually important. And each person is different. So you see how like this allows you the opportunity to look at any of the block trades and trade whatever is actually fits into your wheelhouse, versus just like doing an arbitrary scan and then having to trade that scan even though you don't know anything about it. So a lot of the things that I don't like about the scan is the scan usually is kind of implying it's the final thing, right? So you do the scan, whatever is at the top of the scan is the one you do. But my thinking is the scan and all these information is the beginning of your trade, right? It's the idea generation of trading. So one of the most important things about trading that's frustrating for most folks is it's hard to get new ideas, right? So you watch TV, you have certain stocks that you trade, and like how, you know, where'd you get the new idea? Well, a lot of times there's these scans, but if you don't really trust the inputs on the scans, or if you don't know the stocks that it's producing because of the output, well, how can you trust it and do the trading? And to me, this Livevol X is the only software that basically has this like massive array of order flow and volatility information that allows you to generate ideas, right? So I would have never traded YHOO yesterday if it didn't reach 52-week high in implied volatility. So it was at, in last 52 weeks, it was the highest it's ever been, right? And all the order flow, basically, a lot of it has been very positive. So like basically people are like betting on the calls, because I guess like people who actually know YHOO knew that they would have had to say something about Alibaba, and here I go, I didn't even know that, right? So I know less than probably these other guys who knew that they would actually talk about Alibaba's metric for the quarter, and I didn't even know that, right? So that was probably why people are betting on all those calls. But what I was using was I was using the volatility, I was using the order flow information, saying that people are betting on the upside, and there is a specific mathematical relationship between the calls and the puts, which if calls keeps going up, and so if people keep buying the calls, it automatically raises the put price, even if nobody buys a single contract on the puts. And if you guys are really interested, you guys can basically go and, you know, crack open a Natenberg like I did when I started, and basically read the put call parity relationship, and you guys can figure it out. It's in the books. You just have to spend a couple of hours reading it. But basically know that the calls and the puts have a relationship, and they actually move together, right? So that being said, I knew that the puts were being inflated because of the calls. Because people are buying all these calls, the puts are being inflated, so it gave me like extra cushion on the put side, right? I was kind of bullish with YHOO and Alibaba anyway, And I like, technically, I thought 32 was kind of a good support for Yahoo. So all those three factors basically allowed me to trade. So did I actually like come up with the Yahoo trade? No, I basically didn't. But the fact that all these scans kind of showed me that Yahoo was at a 52-week high vol, that the order flow information was mostly on the call side and they were betting on the upside. So basically the put side was being ignored. So all these information basically allowed me to put on that position, right? So this software to me is by far the best options trading software in the world. It's not even close, right? So there's other software platforms out there. If they were that great, the professionals would be using those. But the fact that people actually have all this information up, and all the broker dealers on the sell side, the guys who give recommendation to their clients, they actually have this and they follow the order flow and they do the analysis, and then they call the desk and say, hey, Joe from this bank, I think you should do this trade because I think it's a good trade. So these guys actually use this software to actually make those decisions, come generate ideas. Well, the whole thing is, now this power is in your hands, and you guys can generate the ideas yourselves and trade. And basically, hey, look, you don't need other people. Basically, all the information is in front of you, and you basically use that information to reinforce what you're already kind of thinking, and you just piggyback that trade. So, I talked about about 10, 11 trades I did in the past couple of weeks where I'm piggybacking the trade, right? So this IWM is a perfect example. I was just about to come on the air. I look at this watch list and I see IWM trade, right? But there's tons of IWM trading. I mean, if you look at it, why is it that I actually gravitated towards that one versus like something else? Because people always ask me, like, how do you know which one of these you're gonna pick? It's like, yeah, the truth is, I don't actually pick them. It almost picks me. So while you're going through this, you'll actually see a stock that that you recognize, and you actually click on it because you want to know more about it, right? So like this one, like Delta Airlines, right? Somebody's buying these calls, right? April 1931 and a half. All right, so basically they swept it for 135. It was at 1207. And now they're trading 170. Right, so it's one of those things, like there's some people out there who actually use this to day trade. So they'll see this block go up in the front month, and they'll know that's like it's pretty much a day trade, right? So they'll actually, as soon as they see this order flow, they'll piggyback that order flow, and they'll try to get this upside for the day. It's not really my game plan. I'm not really that good at it, I've found out, because I always seem to follow the wrong one. Because I think what happens is you look at this technically, and then this tick chart, there's like something that tells you, hey, it's a buy signal, and then if the order flow comes in that's also a buy, then you should actually buy the option, right? So it goes both ways. But just so you guys know, if you guys want to give this a try, go to livevol.com, click on Livevol X, and you can try an account. And you can actually read about us on Barron's. They wrote an article about the software. I think it's pretty good. But in the end, I think you have to use it to really see how awesome this product is. And you will not know it until you actually use it. And sometimes I feel like people feel it's too overwhelming, but not really. If you actually figure out a couple of stuff, like if you can follow the relationship of this red line and blue line, and you can actually look at these block trades and basically figure out if they were bought or sold, you can pretty much put on a trade that you want. But other than that, I'm kind of happy because I'm making little money today versus always losing. But I hope your trading is going well, and I'll talk to you guys tomorrow. Just make sure that you guys are ready to close all your positions by tomorrow, because we do have expiration Thursday versus Friday. But other than that, take care and talk to you guys tomorrow.